What is up, guys? Welcome back to the channel. My name is Matthew King, and today I'm going to be talking about the Nasdaq. So what the Nasdaq is it's a stock market similar to the New York Stock Exchange. So I'm sure you guys know what the New York Stock Exchange is, but basically it's a market that just has a bunch of stocks in it, kind of like the Nasdaq is, but the Nasdaq is mostly tech stocks. Like Apple, Google, Microsoft, and Amazon are some of its biggest companies. So the Nasdaq defined would be the global electronic marketplace for buying and selling and trading securities. So it's kind of a mouthful, so I'm going to break it down. So a security represents ownership in a company, so kind of like a stock. There are two types of securities. There's a debt security and an equity security. So they're both pretty self-explanatory. So a debt security would be when one party borrows money for another and pays it back with interest. So basically a bond is what a debt security would be. And then there's also equity securities. So equity is showing how much ownership you have in a company, so or in any item. So if you have a house that's worth $250,000 and you've paid $100,000, that would make it you'd have $100,000 worth of equity in the house. So it represents an ownership in a company's net assets, and those would be just your typical stocks. So stocks are typically a little bit riskier than bonds. Bonds are almost guaranteed you're going to get your money back. But stocks a little bit riskier, but typically if you when they do better, they do quite a bit better. So one of the main differences between the Nasdaq and the New York Stock Exchange is their setups of selling and trading. So the Nasdaq has what's called a dealer setup versus the New York Stock Exchange is an auction market. So the dealer would be someone who buys securities as a business and for bid price, and then sells them for a markup. So for example, if you bought a stock of Apple for $100 as a business and then sold it to someone for $110, that would be, you would be a dealer basically, versus the auction setup or auction market setup, which is what the New York Stock Exchange has, which is where you buy based on bids. So for example, if you have 4 buyers and they all want to buy a share of Apple, and one bids 10, one bids 11, one 12, and one 13, and then you have sellers, one person bids 17, one person bids 16, or wants to sell it for 16, 15, and 13, it would go, the stock would be priced at $13 a share, because it would be the lowest the person selling it would sell it for, and the highest someone would pay for it. So that's how it would work on the New York Stock Exchange, and that's how, if you've heard of market bubbles, that's how they're created, because people would value an industry higher than it's actually worth, and it would eventually crash. So if someone said I want to pay $15 for this, but it's really only worth $12, then eventually it's going to catch up and it's going to crash. So that's basically, if you hear they're expecting a bubble is going to come, just know that that's what it means. And it's hard to time the market, but if you're sure, that would be a good time to sell before it crashes. So that's it for today, and I thank you guys for watching. I hope you guys stick around for next week's video. I'll see you then. Thanks for watching.